Welcome to Wednesday's Q&A, and today you have me. So I'm just going to jump right into it. And remember, if you have a question, just send it to questions@itmtrading.com. So I'm going to start with Carol K. Did you say our cash deposited in our bank may be confiscated even if the balance is below $250,000 in the event of a bail-in? If the FDIC doesn't have the money to insure deposits, they simply won't pay? Okay, so there's two questions there. Let's do one at a time. So yes, actually they tested, the Bank for International Settlements, the BIZ, came out with a template of how they would do this bail-in with or without the FDIC insurance. And in Cyprus, when they tested it, they first just took everything, completely ignoring the deposit insurance scheme at the EU. And of course, the whole world went, what about that? What about that? So then they honored that, even though you still didn't have access but to like $300 a day or something like that, regardless of what you had in. So my bet is, and they figured out how they would make that adjustment so that they could honor that FDIC insurance in this country, or any insurance globally, that the deposit insurance scheme. So likely, to not create more havoc than it's going to create, they will honor that $250,000 insurance level. They may or they may not, but most likely, since they tested it first without honoring it, and there were too many people that went up in arms, they will honor it. So that kind of takes us to the next question. If the FDIC doesn't have the money to insure our deposits, they simply won't pay? Well, you know, I periodically run those numbers, so I will do that again and do one on how much they have in, it's called a DIF account, Deposit Insurance Fund. But truthfully, if one bank goes out at a time, then you won't notice. But when I did it the last time, they had just a little bit more than 1 penny to insure the deposits. So if a lot of banks go out at the same time, then yes, it's going to be obvious to you that they don't have any money in that DIF account, or they have a minimum amount. So stay tuned. I'll put that back. Edgar, could you remind me? And I will put that back in, and I'll do a report. We'll see how much they have in the DIF account now, and we'll talk about this more. But yeah, but here's the thing. If we're in a hyperinflationary mode, or even a high inflationary mode, you have no access to that money, even if it's insured. Like it was 2013 in Cyprus, where they eliminated your ability to access your full balance, and it took until sometime, I think it was 2015, maybe 2016, until you had access to it. So if we're in a hyper or even a high inflationary mode, what will that $250,000 buy you after you finally might have access to again in 2 years? Less. So there's all different ways to steal your wealth. Make no mistake about it. And yeah, the FDIC, I mean, they put that in place back in '33 so that people would actually trust the banks again because, hey, it's insured. But that is counterparty risk, because any insurance contract is only as good, or any contract is only as good as the counterparty on the other side. And if they don't have the money to pay, what they did this last time, 2008, was they raised the insurance premiums for the banks, so they tried to rebuild that DIF fund. But I will do that maybe next week, I'm not sure. But it will be very soon that I'll put that back in the rotation. We'll take a look at it. And Ross K asks, I sold all of my stocks and have kept cash in my IRA account with Ameriprise. Is that account susceptible to a bank bail-in? Yes, they're all susceptible to a bank bail-in, 100%. Will they honor the insurance? Probably. But, you know, I mean, dollars, I'm sorry. You see this inflation? This high inflation is showing you that the purchasing power is eroding and there's only 3 cents left officially. Henry T. asks, would you ever use a portion of equity in your home mortgage to secure gold and silver, then after the reset pay off the mortgage? Personally, no, I would not do that, and it would be really hard for me to recommend anybody taking on debt to do it. Do I know people that have done that? Yes. Timing is the biggest challenge for any technician, so I can tell you what is most likely to happen, but I can't tell you exactly when. So I would personally never make that choice. You have to do whatever you're comfortable with, but that's not something that we would recommend here at ITM. And Alana D. asks, who is going to buy gold from us when it goes up to its true value? Why would anybody buy it when it is so expensive? Well, if you think about the Depression for a moment, right? Not many people had money, but all money does not evaporate. So if you think about, you see these horses behind me, and these are from the 1930s, and they're all hand colorized, and I think I have Seabiscuit. Isn't this? Yeah, this is Seabiscuit right here. And you might recall that Seabiscuit, if you, whoever won that and Seabiscuit happened to won a prize of $100,000. Now that might not seem like much money today, but during the Depression, that was a huge pot. So the point is, and even in Venezuela, that's in hyperinflation, 90% of the population is in abject poverty. I didn't say 100%. Wealth never disappears. It merely shifts location. So if you get poorer, somebody else gets richer. And when you have wealth, number one, you always want what nobody else can have but you because you have wealth. And number two, at that juncture, we're in hyperinflation like you're asking us, and there's overnight revaluation. Those guys, that's called the smart money. They are buying gold hand over fist because they know it's going to get worse. Why do you think global central banks have been buying massive amounts of gold, more than they ever have since they started tracking it? Because whoever holds the gold retains the power, the choice, and the purchasing power. It's not gold going up, it's the currency going down. That's what it really is. So that's why anyone and everyone that has the ability to do so. Look at Zimbabwe. I did a video on this in the last couple months or so, something like that, where now, after they've been in hyperinflation for so long and the country is basically decimated, they're coming out with a 1-ounce gold coin so that you can protect, the wealthy can protect their purchasing power. Because a normal person certainly can't afford the gold, but the wealthy can. So they would do that to hold it. It's not really expensive, just in terms of that currency, and it's all about perception. But it isn't really gold going up, it's the currency going down to zero. And at that point, let me tell you, when we go into hyperinflation, people understand that very, very clearly. And Dave Q asks, many talk about a new monetary system based on some commodities or even a basket of commodities. Being that commodities often vary in value based upon a number of reasons, well, poor harvest, nations limiting productions, commodities being consumed, thus increasing rarity, etc. Could this be possible for any commodity other than gold or silver? No, not really. What happens when you have what they call of as a commodity currency is that you have those oil reserves, gold reserves, silver reserves, the commodity reserves, and so you could use it in that way, but it is not likely that a currency would be based on a basket of commodities for some of the reasons that you're talking about. But what I really want you to get is that once we went into this debt-based system that was controlled by corporations, because that's what a central bank is, it's a private corporation. And once we went into that system, they systematically converted every single asset to a Wall Street product, a tradable product. So a lot of what you see moving these markets has really nothing to do with poor harvests or nation limiting productions or commodities being consumed and thus increasing rarity. It has everything to do with traders wanting to make a buck and using those speculative derivatives to do it. They never take a possession of the underlying asset. But no, and gold is the primary currency metal, silver is the secondary currency metal. What's the difference between the two? Well, frankly, gold is recoverable. So we can account for about 98% of all the gold that has ever been mined. So gold is the only one, whereas silver gets used up in production, etc. So that's why gold became the primary currency metal. There isn't any other commodity that can come up and do the job that gold has done over all these years. But will they put gold back in it? Yes, because they're going to need to get our confidence again. Gold is the primary currency metal. It's what they do that overnight revaluation against, because the currency itself, the fiat money, the dollars, the euros, the yen, whatever it is, has no intrinsic value. And I've had so many people say, well, you can't eat gold. You're going to eat those pieces of paper, or even better, how about those digits that are kind of in the ethosphere? You're not eating that either. It's critical that you understand that physical gold, physical silver, has the broadest base of function. It is used in every single sector of the global economy. And so gold and silver have the broadest base of buyer. No other commodity can say that. And certainly no fiat money instrument can say that either. So make sure that if you haven't watched this yet, I mean, we are on the countdown to the LIBOR-SOFR transition. And, you know, the countdown ends on June 30th of 2023. So less than 6 months away. And I did a video yesterday on the end of LIBOR and why central banks are binging on gold. And it has a lot to do with the CLOs that we've talked about. So this is the countdown. You're going to hear me talk more and more about this as we move closer and closer to June. And you want to make sure that you watch that. And also watch tomorrow's video that's coming up, where I tried to do it very quickly and succinctly on why we're at where we are and how the central bank is at. I'm showing you why the central banks are out of tools and what the next most likely outcome is. It's a really short video. This was not an easy thing to do, but you don't want to miss that either. And if you haven't done so already, click that Calendly link below, because you need to have a strategy going through the rest of, well, certainly we're in 2023, and I could be wrong. And maybe this great experiment, this LIBOR to SOFR transfer, maybe they can pull this off. But remember, they had to force compliance. Wall Street doesn't think that they can pull this off, and they're starting to get a lot of pushback going into the next 6 months. So get your strategy in place and get it executed as quickly as you can. Because I can tell you what the next most likely outcome is, but I can't tell you the exact moment. Nobody knows that. Nobody does. So if you haven't done this yet, make sure you subscribe and hit that bell below. We'll let you know when we're going on. Please leave us a comment and also give us a thumbs up. It helps spread this information more. And share, share, share. Ignorance doesn't make you immune. It just leaves you vulnerable. And until next we meet, please be safe out there. Bye-bye.